Good morning, all of you. Myself, Dr. Ibha Rani. In this video, I will be discussing about what do you mean by capital budgeting and what are the techniques are being used by a company to evaluate this capital budgeting process. So first we will understand what do you mean by capital budgeting. So it is a process through which businesses or any company or firm use to evaluate major project or any other investment. So company wants to build a new plant or they want to expand their business. How they will evaluate these options. For example, company wants a building. Now the building can be purchased or the company can go for to purchase the land then construct the house, or already the buildings are there, they could have taken on rent, or they can taken on lease. So these are the options are available through which the company can go for the expansion plan. But which plan is best suited for that particular company, this we can evaluate through the capital budgeting process. So it is a tool through which capital expenditure or major project or investment such as new plants or equipments or machines are being evaluated. It involves capital budgeting process involves analyzing a project cash inflows and outflows. How they will be looking into that? They will be considering what is the cash inflows from that and what will be the cash outflows from that project or for the investment. Then based on that, they can decide which project is beneficial for them. They will use a expected return means a set benchmark. So what will be the expected return or set? There are various methods of capital budgeting, which may be cash flow analysis, payback analysis is there, net present value methods are there, internal rate of return methods are there. But these are the methods which will include the uh, cash inflows and outflow based on the present value. But there are some other techniques where the risk are being considered. Those techniques includes in the capital budgeting in later stage. In starting, when you have learned in the fourth semester, when capital budgeting is you have learned in that only these discounted cash flow and based on the non-discounted cash flow is there. But here we will be considering the risk factor as well when you are going to evaluate any project or any investment for a company. So now what is risk? Risk will be any activity or any investment that presents a potential for gain but also contains the possibility of a loss. So risk can be your probability, the possibility whenever you are investing in any project or in any company or any firm. So it will be the probability of loss or it will be gain. But when it will be a profit, there is no calculation. If it is a loss, company has to look into that what are the maximum extent the company can be in loss. That's why risk analysis is very important. In finance, in investment, risk is the probability that actual results will differ from the expected result. It means that I have invested in any project and I am expecting that there should be 10% return I am expecting from this investment. But this return, when it will be not getting the 10% or 12% return, then it will be loss for the company. So there are risks can be associated with various aspects of life. It can be business, in financial investment, or even in personal decisions also. Here, risk is an integral part of any business or a life. If you are in investing any places, this will be the potential probability of loss. Now we will try to understand what are the different types of risk involved in this. So risk plays a significant role in finance and in any investment decisions. In this video, we will look into the different types of risk. There are majorly two types of risk. One is systematic risk and one is unsystematic risk. So first, let us understand what do you mean by systematic risk. Systematic risk is also known as undiversifiable risk, or sometimes it is resembling with the market risk. So it cannot be. Undiversified risk means which cannot be diversified away, and it is typically caused by macroeconomic factors which is not under the control of any company or any firm, such as it can be inflation due to changes in the inflation rate, due to change in exchange rate, maybe political instability in that particular country, or any natural disaster happens. So these are the things. Systematic risk, you know that risk, whenever we are in investment, we keep on saying that do not put all your eggs in one basket. But when it comes to the systematic risk, which cannot be diversified, even you have, which cannot be avoided even after the diversification of the risk. In the systematic risk, there are different types of risk you can consider it. First is the types of the systematic risk I'm talking about, that is the market risk. Market risk, sometimes it is resembling exactly with the systematic risk, which relates to those factors which affect the overall market. So for example, your company is in India, so whatever the Indian market, it will be impacted. Entire company which is working in India will be get impacted for those factors. It can be economic condition of our India, or interest rate of the India, or any geopolitical event something happens. So it can be political instability or political stability, it can be natural disasters, it can be changes in the investment patterns or any events. So that will be considered under the market risk. Second risk under the systematic risk is purchasing power risk. It is also sometimes known as the inflation risk. It is the risk that the real value of money decreases over time due to rising price. You know, every years the price of goods and services keep on increasing. This is due to the inflation. The price of the goods or services keep on increasing every year, so that will include under the purchasing power risk. Inflation erodes the purchasing power of money, leads towards the reduced affordability and lower return on investment. It's a major concern for investors as well as savers. So you can use certain strategy to mitigate purchasing power risk, which can include the investing in assets that outpace inflation, such as the stock market. So for example, if it is 6% inflation rate is there, I can invest in on those investment avenues which will give me better return than the inflation rate or 6% return. If the inflation rate is 6%, I have to look into those investment options which will give me better than 6% return. The third one is under this market risk or systematic risk is interest rate risk. It relates to the changes in interest rate impacting the value of the investment. Particularly, it will be focused majorly on the fixed income assets like bond, debentures, government bonds. These are the interest rate risk related to that. Company RBI keep on changing the interest rate. Based on that interest rate, the company also will keep on changing their debentures or bond interest rate. So this will be, there are interest rate also is divided into two: price risk and reinvestment risk. Price risk is the potential for bond prices to fall when interest rate will be rising, and reinvestment risk is the possibility of earning lower returns when reinvesting coupon payments at low interest rate. Interest rate can be influenced by economic condition or central bank policies. In India, RBI keep on changing the uh, rate, different interest rate, so that will impact inflation expectation, or global financial market also will impact the interest rate risk. Now the systematic risk, I have discussed the systematic, which is known as undiversifiable risk, which you cannot diversify, which you cannot minimize after the diversification of your portfolio also. But comes to the unsystematic risk, it is known as unsystematic risk is exactly opposite to the systematic risk, which is also known as the specific risk or diversifiable risk. Why it is known as diversifiable? Because you can avoid this type of risk by diversifying your portfolio in different investment avenues. So it is specific to an individual investment or industry or that particular sector. That's why it is known as specific risk, or it is also known as diversifiable risk. It is associated with the company, where company can be reduced and can be managed effectively either by diversification or by forecasting or estimating. Certain examples of unsystematic risk, which include changes in management structure, asset mispricing, certain legal issues, and the technological disruptions. In this unsystematic risk, we will be having the different types. Business risk, that is the business risk is also known as operational risk, which will be the risk which is associated with the core operation and activities of a particular company. So I have invested in ABC Limited company. So business risk is associated with particularly only to the ABC Limited company because of the certain core operations or certain activities of that particular company. For example, it is a manufacturing company which is facing supply chain disruptions due to certain natural disasters or labor strike, which could impact production and revenue of that particular ABC Limited company. Next risk is financial risk. It is related to companies' financial structure, including its debt level and ability to meet its financial obligations. It is basically related to the capital structure. How much company is having the liabilities to pay, that will be related to that particular company. That's why it is the financial risk. Suppose a company takes on a significant amount of debt to finance its expansion, and if the company's earning decline in future, it may struggle to make interest payment, which will lead towards the financial distress of the company. Under this, last is credit risk, which is also known as default risk. It pertains to the risk of a borrower failing to repay their debts or its obligations. For example, in banking industry, when an individual or business or a firm or a company borrower fails to make loan payment as agreed, every year as a borrower, I have to give my EMI. I have taken one home loan and I have to pay maybe 50,000 per month. But I am unable to pay my 50,000 per month. It represents the credit risk. A person defaulting on a mortgage is an example of also credit risk of the lender. It is often associated through it, you can assess through the credit score and credit report of that particular company or an individual. It will help the lenders to look into that borrower defaulting. Businesses and individuals can use various strategies to mitigate this credit risk, such as diversification, risk assessment, and prudent financial management. So I hope you have cleared with the different types of risk associated. Maybe it will be systematic. Quick review: systematic and unsystematic risk. Systematic is undiversifiable. Unsystematic is which you can diversify and you can eliminate those risks. Under systematic, you have market, purchasing power, and interest rate risk. Under the unsystematic risk, you have business risk, financial risk, and credit risk. I hope you understood this concept of the risk and its types. Thank you all.